Okay, you can still hear me, right?
I can hear you.
Okay.
Was that your phone ringing?
It was mine.
Okay, no problem.
Spam call. I get like 400 of those a day. All right, guys, welcome everyone that's on so far. Just obviously you're on a little early, which is great. We're gonna start right around 11, might wait a couple of minutes for last minute people to hop on. So just be patient and we will be starting soon.
Sounds like a good plan. Duncan, which office are you working out of?
I kind of float, to be honest. I mean, I'm working between the Beverly Hills office and then the South Bay, Torrance, and Redondo, and West Hollywood. So I'm kind of wherever, I have clients already or wherever I'm meeting clients, but I'm part of a lot of South Bay stuff as well.
Where's your South Bay office? I don't know where it is.
We have one in Torrance. It's in the same building that Compass is in. And then we have one in Redondo Beach. And then we have one in Long Beach and one in Seal Beach now.
I didn't know that.
Yeah.
Good to know.
Yeah, and our escrow officer in Torrance office is pretty amazing. She's great.
Who is that?
It's Lisa McMullen. She used to be
Sure.
Yeah, you know her?
Glen
Yeah.
Oaks.
She was with Pinnacle, from what she told me.
Oh, maybe that was Pinnacle. That's right.
Yeah.
That's right.
Yeah.
I did not know that she moved.
Yep.
Right.
Yeah.
Good.
Yeah, she's loving it. And she's great. I've sent people to her. They love her. So it's been great.
I'm telling you, escrow's everything.
Yeah.
It really
yeah.
is.
In this business for sure.
Good. So do you have Thanksgiving plans at this point?
I do. I have some family in San Diego, a cousin, so I'm going down there. So that'll be fun. I'm excited. It's actually their first year living in San Diego. I'm from Chicago. They were all they were previously all living there, so it'll be good to have some family around here.
Good.
How about you?
Yeah, we're just going to go to my sister's. We do that typically on Thanksgivings, and we have Christmas at our house. But that's out in Laverne, so it's about 30 minutes from where I live in Whittier.
Oh wow, yeah, that's far. Well, it's not as far as San Diego, but
no, yeah, 30 minutes is not bad.
Yeah.
In today's economy of travel, it's
yeah, exactly. So if the people that are jumping on, I had said earlier, we're going to get started right around 11, maybe wait a couple minutes after, just for people to hop on, but just be patient and you guys will enjoy the presentation. And if you have any questions during the presentation, please do put them in the chat and we will get to them at the end.
Hey, Duncan, are you going to be able to provide us slides for this presentation after the fact?
That's
yes.
Phil. Yes, Phil will be able to.
We can do that. Yeah. Can I just interject something? Hey, let me interject this. I'm going to offer two things. I can get you a copy of this slideshow as long as you promise not to share it with any of my competitors.
You got it.
Number one. And number two, I'm going to make available, I have 20 different marketing letters that you can begin to send to investors based on the information we're going to disseminate today. And that will help you with the process of beginning new relationships with people that you'd like to target in your farm who've owned their rentals for 12 years or longer, who have equity in their buildings.
Okay, perfect.
So we'll make those two things available, and I'll kind of make that known as we begin this morning, and happy to provide that to you.
Thank you so much.
Okay.
And then it's going to be recorded as well, and I'll be sending out the recording to everyone that attended as well.
Okay, perfect. Thank you.
Yep.
You're welcome. Okay, good. Well, it is a 10:59.
Yeah, I think, Phil, we should still wait a couple more minutes.
Yeah, sure.
People
That's
don't-
fine. Because there's a mad rush a minute before to about 10 minutes after.
Yeah, exactly. And we had a lot of people register for this, so I think it's going to be a lot of people on.
Good.
So guys, we're going to get started in about 3 or 4 minutes. Just hang in there. Thank you for being early, as most people aren't. We will be starting soon.
That number is growing.
Yeah. We had a big registration. For those of you hopping on, we're going to get started here in about 2 or 3 minutes. So just hang in there and we will be with you in just a minute. Phil, how many do we have on now?
We're 47.
Okay. So we'll give it about 2 minutes.
Hey, Duncan, just to confirm, you see the Exchange Resources emblem on your right side?
Yes.
Okay, good.
All right, why don't we get started, because I know you have a lot of information to share. And this is going to be recorded, so anyone that hops on late or misses it will be able to send it out. So I'm going to start here. Essentially, my name is Duncan, and I appreciate you guys all for being here. Those of you that don't know me, I'm with Chartwell Escrow as an escrow rep, and we have several offices around LA. And my personal goal is to add value to your business. So I work with agents on an individual basis to learn more about their business and see how I can use my knowledge as a past realtor for 10 years, as well as also having been in title and escrow. So I have a lot of knowledge that I love to share with agents, including scripting and dialogue and things like that. So, that's kind of my role with the escrow company, is I work to kind of be a business partner with you guys and see how I can add value to your business. So would love to meet all of you individually and learn more about your business. And this is one way we're adding value to what you guys do. So Phil, I want to introduce Phil. He's with Exchange Resources. Phil and I have known each other for a long time now. And I've seen Phil's presentation live a couple times, and I just got so much knowledge out of it, being in the real estate background myself. And Phil's been doing this for a very long time and knows exactly what he's doing. And my favorite thing about this presentation for you guys is Phil is not only going to educate you about 1031 exchange, but he's also going to share scripts and dialogue on how you can get investor clients into your book of business. So Phil will go over that. And as he mentioned, he will share those scripts and dialogue with you and the presentation as well. So without further ado, I'm going to let Phil take it away. We I know there'll be a lot of questions, so you guys can type your questions in the chat, but please know that we're probably going to answer them towards the end of the presentation so we don't get bogged down. But it's very informative and there'll probably be a lot of questions. So feel free to type your questions in the chat and we'll get to them at the end. Again, I'm Duncan with Chartwell Escrow, and Phil, I'll let you take it away here.
Duncan, thank you, and good morning, everybody. Some of you already know, you've heard us speak before about this. Some of you, we're going to become new friends, I hope to at least. And the bottom line is we are here to give you that education like Duncan was just talking about. You know, I checked my day timer today. It says that there are 46 days left in 2022. That means in 47 days, it will be 2023. A whole new year will be upon us. You're going to look back to today and say, I wish I had spent some more time putting more seeds into the ground so I can have more of a harvest in the first quarter of 2023, which is only 47 days away. So what we'd like to do is give you some ideas and some thoughts on what you can do to become more effective as real estate transitions. Now, I know a little bit about transitioning because I've been doing this for over 40 years. And I began in the title insurance business and transitioned into exchanges 25 years ago. And here's the bottom line, folks, is that the market changes constantly. I know we get into a 2-year thing where we kind of, you're really busy or you're really dead slow. And the only thing you can do is either short sales, foreclosures, or all kinds of transactions because the market's going nuts. Interest rates go up, interest rates go down. When I first got into business in 1982, interest rates had just dropped all the way down to 18.5%. So I've seen a lot of market changes, but I've learned a few things over the years, and I'd like to share those with you that could possibly create new business for you. So you might want to, if you have your phones handy, you want to take a picture of this screen, and on the lower left-hand side, you'll see my email address and you'll see my phone number. My phone number is there for any time you have a question on a 1031 exchange, and it would be my pleasure at no obligation just to answer that question for you. The email address I'm going to ask you to save for later, because that I'm going to make available to you through that email address a number of marketing pieces if you are interested in contacting investors. Because as you know, investors do business for different reasons. An investor, by the way, most likely owns a primary residence. And a lot of you specialize in principal residence. But an investor either has a business use property or is collecting it for income. And the bottom line is these types of people will sell and buy for completely different reasons. And that's what we want to do with you today, or for you, to be able to give you some knowledge on what you can do to create additional business with your portfolio of investors. So this is what I'm going to do. I'm going to go ahead and mute everybody because we're getting a lot of background noise. And okay.
Yeah, guys.
There we go. Okay, I think we're okay now. So without any more hesitation, let's begin. Like anything else, there's always a disclaimer, right? And my disclaimer to you today is this, basically this. You and I are not in the tax giving business. Our E&O doesn't cover that. We're not supposed to be giving out tax advice. Number two, you and I are not here to give out legal advice because we're not members of the bar. Now, if some of you have licenses to practice taxation and law, that's great, but the rest of us can't. So here's what today's all about. It's about how to create new relationship with people who have multiple properties. And that's what we want to concentrate on. So as we talk about multiple people with multiple properties, we've got to talk about their hot button. What matters most to an investor? So as if you get a farm package from your title person, where you can find out all these people who own rentals, single families, condominiums, 2 to 4 units, 5 units above, and virtually any kind of commercial, retail, industrial type or manufacturing type properties. You can get those through your title people, but my suggestion is only get the one that specifies that your client that they're going to give you, or your prospects that they're going to give you, have had title or ownership to those properties for 12 years or longer. Why? What's inside all those properties that have been held for 12 years or longer? The answer is equity, and a lot of it. And the question is, how are they going to do best? So what is our main intent? The goal is to find out what's important to them. Number one, if you want to talk to an investor, and I know what that's about because I am an investor. My wife and I own investment properties. Not only have I been educated on this and do 1031 exchanges, I do them for myself. So here's what matters most. Number one, you want to hit their hot button? You talk about monthly income. Why? Because people like me and the people who own rental properties out there buy property, so it will generate a paycheck for us every single month. If you have one rental, whether it's a condo, a single family, an industrial or a commercial building, it doesn't matter. If you have one property with one front door with a tenant in there, you will get a paycheck every single month. You can count on it. Number two, if you have 4 front doors, like a 4-plex or 4 condos, 2 duplexes, whatever, you've got tenants in them, you can count on a paycheck on an average in a month every week, because you have 4 front doors, 4 weeks in a month. I think you get it. If you have 30 front doors, 30, you will get on average in a month 30 paychecks, which means you average 1 a day. Folks, that's what motivates investors to buy property. They want monthly income. Frankly, they want the property to work for them so they don't have to. And you'll find some of the most affluent financially, maybe not sophisticated, but certainly financially affluent people who own property. Now, owning property and monthly income is really broken into 2 sections. And this would be really good information for you to know, so you could eventually share it. That's why we're going to provide you marketing letters at the end of our time together, that you can get 20 different letters, and they deal with different subjects of what's important to an investor, but principally monthly income. And monthly income is broken into 2 sections: cash flow versus rate of return. Those are the 2 things that matter most, and we will deal with those in a couple of minutes. Number 2, the second thing that matters most to an investor is equity growth, appreciation. Folks, the biggest regret, and my client base is all over the United States. I get calls from, just this morning, Florida, New York, Hawaii. I get them everywhere around the country who want to set up a 1031 exchange and, ingest what I'm speaking with them, and they call me up and they're so excited because they bought it for 300,000. Now they're selling it for $1 million. They bought it for 1 million. Now they're selling it for 4 million. And they're so excited about it. And they want to do it to 1031 exchange. And I say to them, I bet you have one regret. And they say, what's that? I said, I bet you wish you had bought just one more. And they begin to laugh and say, you're absolutely right. I'm wondering if you have a regret that you didn't buy property 5 years ago, 10 years ago, 20 years ago. And we can go on and on and on. But the bottom line is the purpose for the regret is because it grows over time. Even when it hits a high in a market, like it did in 1989, or when it did again in 2005 and 6, even regardless of what the circumstances were then, to grow that property value to be as high as it is or was, the bottom line is the cycle changes. They'll go down in value, but it'll go back up again and surpass the previous high. That's something you can count on with property. Even if you overpay for it, in time it'll be worth more. And people expect that out of real estate. They expect it out of the stock market. But you know what the difference is between us and real estate versus the stock market? See, the stock market will live and die by the growth or the crashing and burning of that stock or that mutual fund. But you see, in real estate, yes, we want the highs and the lows will come, but it'll turn around and go up again. But what do we get with it? Here's the answer. cash flow, monthly income. And the bottom line is we get both. With most businesses or investments just do not generate those two items for us. But what's the third most important thing to an investor? The answer is tax write-off. You know, do you know that the more you make, the more the government takes? It isn't that you're just making more money, so they're going to take the same percentage of what you made because you made more, but they raise you to a higher tax bracket because you made more. And the more an investor accumulates properties over time, the more money they make, the more valuable their properties become. So what does the government provide to help us reduce the amount of taxes? So on the rents that we collect on an annualized basis, one of them is called depreciation. Depreciation allows us to take the value of the purchase. Now, the purchase is going to be broken down by your CPA into two sections. One is called the value of the land or land value. The other part is called the improvement value or the value of the building. And your CPA will separate those two values from your purchase price. The land may not be depreciated, but the building and the improvements are depreciable. If you look at the lower left-hand side, if it's a residential building, you get to depreciate that value for 27.5 years. If it's commercial, you get to depreciate that building value for 39 years. Most investors like residential better because residential, frankly, you know, how many of these people are going to keep it for more than 25 or 30 years? You know, so the depreciation factor is more over a little shorter period of time at 27.5 compared to 39, but it allows you to write off the building to reduce the amount of taxes you pay off the rents you collect. The second thing is this: there are other types of write-offs that you have. The depreciation is one thing, but when you put money into your property, like you have to fix something, you have to repair something, you have to paint it, maybe carpet, you know, the disposal breaks, whatever it happens to be, you know, those types of things, you could take the entire write-off of those. You also take the write-off when you go visit your property. I was just recently speaking in Beverly Hills, and I was talking to one of the agents who we've done a number of exchanges for him over the years. He said to me, you know, I just recently bought a couple of properties in Las Vegas. I said, why did you buy in Las Vegas? And he said, because now I get to go there and write off my trip because I'm going to go visit my property or the tenants. It's perfectly legal. So the bottom line is, as long as that's really the reason why you're going there, you might do other things as well, but I think you get my drift. The bottom line is, whether you're visiting the property, whether you're doing something to the property, whether you're paying for the property taxes for the property, the insurance for the property, the maintenance of the property, and the interest off the mortgage on the property, you get to write the whole thing off. Why? Because the more you make, the more the government will take. And as an investor, you really need to have some kind of write-offs, just like you do in real estate. As real estate agents, pretty soon you're going to start putting your receipts together and your mileage together and everything that you spent to promote your business to reduce the amount of taxes that you're going to pay for 2022. Same thing with an investor. So these are the three things that matter most: income, appreciation, and tax write-off. But herein lies the opportunity to begin to communicate with that investor. So how do I get your properties to do more in terms of income, to accelerate depreciation, or to even create more tax write-offs? So I'm going to give you a little lesson here. This is something that can really change your business in the way you communicate with people. This is something that a lot of folks don't get, but I think you will. I want you to pretend for this illustration that you bought two properties and you close escrow on those two properties, property A on the left in red, property B in the blue on the left. So what happens is you bought these two properties, and let me tell you a little bit about these properties. First of all, you closed escrow on these two acquisitions 12 years ago in the same month. So you've had it the identical amount of time. Number two, these two properties are on the same street in the same city. They have this, they're next door to each other. They have the same square footage. They have the same floor plan. They have the same lot size. They're in the same condition. In other words, these two properties that you bought 12 years ago or longer, they're identical. There's nothing different except for one thing: cash flow. Did you know, I'm sorry, the wrong slide. Property A has more equity than property B. That's the difference. Now, you may have taken a refi out on B, to have more cash, and that's fine. You didn't do that on A, or perhaps you're accelerating principal payments on A when you were making your payments. Whatever the reason is, you bought them at the same price. They're identical properties. So here's the deal. Let's measure this thing we just spoke about, income appreciation and tax write-off, based on two properties that you own. Number one, we said income is based on two different items: cash flow, rate of return. So let's say cash flow. Which property will generate more monthly income for you as the owner? Did you say property A? You're right, because property A has less debt. Property B has a lot more debt, like we just recently illustrated. So here's the bottom line. A is a perfect scenario for people who have just retired and need more income because they're not working anymore. They're depending on their rental properties to provide the income they need to do what they want to do with the rest of their years. So it makes sense to pay off your properties after you retire, but not before. And I'll show you why. Let's go back to A and B. We know that cash flow is better with A because there's less debt than B or no debt. But what is the better rate of return to you as the owner of this property in terms of the equities that are in these properties? And you have a lot more equity in A than you do in B. Which gives you a better rate of return for the equity that's invested in the property? If you said property B gives you a higher rate of return, you're exactly right. Why? Because simply put, A cannot charge more for rent because A has more equity. Did you get that? A cannot charge more for rent because there's more equity in A. What predicates my ability to charge rent? The answer is whatever the fair market rent is for that neighborhood, for that type of building. And these are identical buildings next to each other. So they're going to generate about the same amount of rent. But I have less invested in B, and I can still charge the same amount of rent that A is charging. Do you kind of follow this pattern? So here's the conclusion. And if you can grasp this and be able to explain this to a client, their eyes will open. The higher the equity, the lower the rate of return. The higher the equity, the lower the rate of return. Why? Because having higher equity in a property does not justify your charging more rent because you have more equity. And that's why an investor will, if you look at the bottom right-hand side in yellow highlighted in green letters, they will re-leverage the equity in A to create more doors or more buildings that will create additional doors that will create additional monthly income. Does that make sense? That's why people will either refinance A and buy another building, so they'll have A and C, for example, or sell A and do a 1031 exchange. That's item number one as far as income. So you could actually do better with more doors over time, especially because the last time I checked, rents are not going down, folks. They're still very, very high. So the bottom line is we don't anticipate they're going to go down either. Number two, which properties will appreciate faster that you own these two properties, A or B. A has more equity than B. The answer is, well, they're going to appreciate at the same amount, the same rates. Why? Because the comps are going to be the same because they're identical properties. So they're both going to go up in value in an appreciating market, and they will go up again. The question is, which property do you own? Well, if you own them both, they're going to appreciate identically. So B is getting a higher rate of return on the appreciation because there's less of your equity invested with B than there is with A. So B wins again. Number 3, which properties have bigger tax write-offs? Well, you say they're pretty identical. They're going to be depreciated at the same rates. And for the most part, you're right. Same is going to be true with repairs and, paint and carpet, that kind of a thing. But B has something they can deduct that A doesn't or has very little of. And that's that precious interest rate write-off, which reduces the amount of income taxes B will pay off the rent it collects. So B actually performs better in tax write-offs, as much in a depreciation, or I'm sorry, appreciation, and in terms of a rate of return, because it has less equity that can do the same amount of work, unless, of course, you retire and you need to have as high as cash flow possible. And that's why you pay off the property. And that's how it works. That's what people do. They'll buy a condo, they'll get rid of it, they'll get a duplex, then they'll get rid of that, and then they'll buy a 4-plex or a 5-plex, and it goes on and on and on. All I do is talk to investors all day long, and this is what they do. So what happens when you sell property? And by the way, if you have any questions, put those questions in the chat room, and we'll be happy to make sure that at the end of our time together, we'll go over them. So if you sell the property for $1 million, but you bought it at $300,000, you have a gain of $700,000 if you elect to sell the property. Now, if you elect to sell the property at 300 at $1 million, your CPA will take the sales price, subtract what they call the purchase price, or what they call is the adjusted tax basis. That leaves them $700,000 worth of gain. That has nothing to do with how much equity you have in the building. So the bottom line is the basis or the purchase price is what you paid for it, but then your CPA will add capital improvements, deduct depreciation, add closing costs. That basis will go up or down depending on what's going on. Now, keep in mind that depreciation has nothing to do with your personal residence or your second home or your vacation home. This depreciation factor is only applicable to a business use property or a rental. All right. So if this situation was your clients and they sold it for $1 million, and you listed sold it for them, they will be paying taxes on $700,000. Let's say it's their principal residence. Well, if you're like me, I'm married, filing a joint return with my wife. We both own the property. We've owned the property for at least 2 years. Then the government will give me up to $500,000 off my $700,000 gain because I qualify for the 121 principal residence exclusion. So that means 700 minus the 500 exclusion means I will then pay taxes on 200,000. If I was a single person and I qualified for this 121 principal residence exclusion, I will get up to $250,000 of gain off that $700,000 capital gain, which means now I pay taxes on $450,000, not the $700,000. If this is my beach home or my mountain home or my desert home, whatever, it's vacation, whatever, second home, whatever, I get 0 off of it, which means I would pay 100% taxes on the $700,000 for selling the property. If this is a rental property, I can exercise a 1031 exchange, but if I don't, I would pay taxes on the $700,000. So here's the question. What does that look like in real life or real time with real numbers based on today's tax categories? And here it is. Off that gain that you had, you will pay on an average of 15% as high as 20% to the IRS. So you pay between 15 and 20% on the 700,000 of gain or whatever it happens, 200,000, whatever it happens to be. Okay. Some people call me up and say, I'm thinking about and debating whether I should do a 1031 exchange. And honestly, I'll just pay the 15% or the 20% and be done with it. My answer to that is, excuse me? I said, what do you mean 15 to 20? That's only one tax. You see, when you sell real estate, you have to pay more than one tax. The second tax you pay is number 2, 3.8% to the Medicare healthcare program. You say, what's that? Well, that is also known as the Affordable Health Care Act, Obamacare. I really don't care what you call it. But when you sell property, you have to pay for it if your gain is 200,000 or more as a single person, or if your gain is 250 or more as a married person. Then you kick in addition to your 15 to 20% capital gains tax, the additional 3.8% Medicare tax. Then we're not finished yet. You have to pay the state of California. Now, I'm a native born Californian. I was born in the city of Los Angeles. I have never not lived in the county of Los Angeles my entire life. But when you sell property here in California, and by the way, I don't know if you know this, we're the #1 state in the union. What I mean by that is we're the #1 tax state. We have the highest tax than any other state in the United States of America. So if you sell your stocks, your bonds, your mutual funds, and by the way, your principal residence, your second home, your vacation home, or your rentals, you will pay an additional 9.3 to 13.3% to the state of California, to the Franchise Tax Board. So it isn't just the 15%. It's to that, number 2, the 3.8 to the healthcare program, and of course, the 9 to 13% to the state. That's applicable to any property you sell. But if you're selling a rental property or a business use property where you're the owner user, the government puts on a 4th tax. And they gave you this depreciation that they were able to give you so you can write off the property so you can keep more of the income that we just discussed off the rent you collect. But they charge you a tax to sell the property off the tax write-off that they gave you. And that's a 25% tax off the allowable depreciation. The word allowable means you can take the write-off, or if you don't want to, you don't have to take the write-off. It's allowable either way. But whether you take it or not, you will pay that extra 25% in the recapture depreciation tax of what you could have taken off your rentals or your business use property, whether you took the depreciation or not. And these are the 4 taxes, the big 4 taxes your clients will pay to sell the property. So what's the motivation for releveraging the equity off to get more income and appreciation and tax write-off? How can I do that if I'm going to spend this much in taxes? In 1921, the government created this thing called a 1031 exchange. The 1031 exchange is there for your clients to be able to take and list and sell the property and releverage the equity into better property to defer capital gains. And by the way, it's a deferral. Did you notice it doesn't say in green on the left, tax-free? It doesn't say that. It says tax deferred. That means the basis and the gain goes with you. You just don't have to pay all those taxes we just looked at on the previous page. Why? Because the more people sell and turn their properties over, not only do you make money, your transaction coordinator makes money, Chartwell Escrow makes money, the title companies make money. I mean, you're paying money on transfer taxes, both city and county, recording fees, my fees, and all the other inspectors and people who are going to fix the properties, not to mention the lenders and all their people and the appraisers and everything with that. Everybody makes money. And when they make money, 2 things happen. Number 1, all of us pay taxes on the money we make. And number 2, we go out and spend. And when we spend, we stimulate the economy. And when we stimulate the economy, people make money, then they go out and pay taxes, and they go out and spend. This is why they created this exchange in 1921, 68 years ago. So no, it's 101 years ago. What am I talking about? So the bottom line is it's to re-leverage the equity so you can have more doors that will pay you rent. That's a good idea, huh? You have more to go up in value as the market goes up again. And number three, you have more tax write-offs. You can move what you have out of the old property into newer, better location property for your investor. That's what's in it for them. So they can grow those three things they want much more than anything else off your page right there: income, appreciation, and tax write-offs. So here's a big question. Which properties qualify for a 1031 exchange? Did you know there's really only one according to the government? It's investment real estate. That's it. But the problem is too many people who own property misunderstand what the government's interpretation is of the definition of investment real estate. So I've highlighted it for you here. So you may want to take a picture of this screen as well. There's only 3 properties that qualify. And by the way, the 3 properties that qualify as investment property have nothing to do with whether it's residential or commercial or M zone or industrial. It has nothing to do with that. Let's go over it. Number 1, the first definition of investment real estate is that you've been renting it out for the last 2 years, by the way. At least that's what most CPAs will say. Some will take less. Most of them stay at this 2-year thing. So as long as you are filing on your tax returns, the last 2 years that you held and declared the income or the rent that was paid on those properties, most likely your client is going to qualify via their CPA for the 1031 exchange. That's number 1. The other possibility is that you've been an owner user. You have had your own business. You own a laundromat business, and you own this little commercial building on Wilshire Boulevard or wherever it happens to be. And you rent, you have a laundromat business, or you have a catering business, or you have a restaurant, you have a manufacturing, you have a real estate business, whatever it is that you do for your business, that building is there for that purpose. And you've been declaring that on your tax return the last 2 years. Number 3, if it isn't income producing, if it isn't business, the last property that qualifies is, believe it or not, vacant land. Because vacant land can be held for what? Investment, for appreciation. You're not going to live on vacant land, right? I guess unless you put a trailer on there or something of that nature, or a tent. But the bottom line is, vacant land being held for the last 2 years qualifies as an investment. Don't you wish you bought vacant land in a city whose last name was Beach? Manhattan Beach, Redondo Beach, Hermosa Beach, Huntington Beach, Sunset Beach, Laguna Beach, Newport Beach. I mean, we can go on and on and on. You get my drift? These are the only 3 properties that qualify as investment real estate. And again, it has nothing to do with whether it's residential or commercial. What matters is if it either generates income, held for a business, or it's vacant land. Now, the government says that when you sell the property and you want to do an exchange, you have to go back into what they call a like-kind property. But what does that mean? Your answer is up in the upper right. It's the sale of investment property into the purchase of investment property. So I've got a question for you. If I'm selling a single family rental and I want to buy in San Bernardino a vacant commercial piece of dirt, is that like kind? If you said no, you're wrong. The answer is yes. You say, well, wait a minute, how can residential income producing be like kind to vacant commercial land that has nothing on top of it? And the answer is because you sold one of these 3, income producing, business use, or vacant land, and you can go into any one of these 3. Remember, this has nothing to do with commercial. This has nothing to do with residential. It's the sale of investment real estate and it's the purchase of investment real estate. And these three types of properties define what commercial or, I'm sorry, not commercial, but investment real estate is. So you can go from the single family to vacant land. You can sell a farm in Nebraska and buy a single family rental. As long as you're renting it out, again, it's got to be investment property anywhere in the United States. You're not limited to California. A lot of folks are leaving California. Yeah, I know, I hear stuff about, a lot of people argue about this, but they are. You know why I know that? Because 25% of my base, and we're one of the largest independent exchange companies in the entire country. I could tell you 25% of my book of business is leaving the state. And going, that doesn't mean other people aren't buying their properties. Of course they are. How else can you exchange outside of selling and buying? But the bottom line is they're going to other places because rents maybe are lower other places, but in proportion, your rate of return is higher in those other states. The tax laws are different. The way they treat tenants compared to the landlords is really different in other states. It's a little more of a level playing field. We've seen people want to move their properties other places. It doesn't matter. The government allows you to do that in a 1031 exchange. So what's not allowable in exchange? Your principal residence, a second home, a vacation home, a business, not the property, but the business in the property is not exchangeable. And generally speaking, flipping and developing depends on the CPA. For the most part, they say no. I've seen some say yes because of that individual circumstance, but the CPA has to define it for your client. What if I own a 4-unit building and the client, I live in 1 unit and the other 3 units I rent out? Well, on the principal residence portion of my sale, I take the principal residence exclusion up to 250 or up to 500, but only on the gain of that portion I live in. The pro rata part is allowed to go into a 1031 exchange, and we set it up for that. So you say, Phil, okay, I keep exchanging. Won't I have to pay the government at some point? The answer is yes. If you later sell and not do another exchange, because you can keep doing exchanges every 2 years on these property. And if you have 100 properties, you can do 100 exchanges in 1 year because you're not flipping. You're just selling something new to buy something different. But if later on you're 95 years old, you look like me, right? You're 95 years old, and then you decide to cash out, you're going to go all the way back to that basis that you originally bought at, that you've been taking from property to property to property, and you will pay all those numbers I just showed you in terms of taxes, unless. And before I tell you the unless, I want you to look at the bottom on the right-hand side. Your client must consult their tax professional, their estate planning attorney for more details or alternative methods. But if your client owns the property in a trust, as an example, or they own the property in an LLC, but their shares of that LLC are owned by their trust. Just as an example, this is just one way. When you pass, the property will go to your heirs in your trust, not at the basis of $300,000, even though you're sitting on a $5 million property. The basis will be stepped up to the fair market value of the property the day you died. The United States government gave that to us in 1954. That would be 68 years ago. The government has tried to change it, even as recent as last year with the new tax proposals. The House said, no, we're going to keep the stepped up basis. We're going to keep this 1031 exchange as it is, and we're going to keep those tax rates as they are now, because they were really trying to propose that really high increases for the upper end, like from 20% to 39.6%. And they wanted to keep real estate moving, because the more it sells, the better off the government is in terms of collecting new revenue from people who are selling and the people who are involved in all the transactions. Does that make sense? Now, let's pass this part because we're running out of time. Things are going by too quickly. If you're taking a listing, you always, and there's a tenant in the property, you ask them, have you been using this property for business, or has it been rented out, or blah, blah, blah. You want to find that out. Why? Because number one, they're eligible for the exchange. And have them go talk to their CPA. Because you and I don't give tax and legal advice. We're just trying to help them do better. Number two, you get to handle the listing. But hopefully you'll be able to help them with the replacement property. Or if they're going out of area or out of state, you might be able to refer them to another Compass office outside of the area and get a referral fee. But in your agent's remarks, you want to type in your listing that the seller is going to do an exchange and that the buyer is going to cooperate. What are they cooperating with? The answer is a company like ours. As you can see here, an accommodator or qualified intermediary. That's what the government requires for your client to do a 1031 exchange. So yes, you put that language in your zip, not your zip form, trying to get, you put it in your listing, your agent's private remarks, but CAR wants you to use what you see down here. It's called the CAR zip form. When you're selling, you want to use the SXA form, the seller's intent to exchange. And this is what it looks like. It does two things. It brings us, the accommodator, into Chartwell to set up the exchange before the sale closes. The exchange must be set up before the sale closes. I get on average 3 calls every week where people have previously closed their sale, whether it was one day before or was a week before or was several months before, and they want to go back and do a 1031 exchange, and the government says no way. It has to be set up before escrow closes. This form that you're looking at, the SXA form, the seller's intent to exchange addendum, allows you to do two things. It brings us in there, so then we can work with escrow. You'll have to make us aware who the escrow officer is and who the client is, so we can go ahead and set up the exchange documents. And number two, it's going to give you an ability to negotiate an extension if you needed to find the replacement property, but I'll get into that in just a minute. The second form that you're going to want to look at is the buyer's intent to exchange. That's when your seller now becomes a buyer and you're helping them by making offers on new replacement property that's going to be better for them. And that's the BXA form that is also located in your zip forms in your CAR website. And these forms are what CAR would really like you to use because they will keep you out of trouble. Next, what about timing issues? And boy, that clock is going by fast. I can't help but looking at it because I want to take the last few minutes to go over all the questions. I can already see there's 13 messages or questions in the chat box, and we'll get to those. Duncan will be able to read those and I'll be able to answer them for you. I want to talk about only the 2 exchanges that are used most today. We will go hopefully to another time where we can come back on a part 2 and go to the extended questions and talk about the other types of exchanges. But for today, you need to know the 2 that are used the most. The first one is called the delayed exchange. Delayed means I'm late. I can't close a purchase simultaneously with the sale. Like if I could, that's great, but it's really a hassle, and most people just can't do that. They need time to find the replacement property. So this is what the federal government says, and this is law. Number 1, from the day you close your sale, not when you open escrow, not when you get an accepted offer, but when the escrow closes. That begins 180 days to close what you're going to buy. Now, some people say it's 6 months. It's not. It's like 3 days less than 6 months. So you have 180 days to close. But what happens 180 days from now if it's a holiday? Like Juneteenth, or well, that's, I guess I'm thinking like 60th. Well, that's not, it would be May. So let's say it's Memorial Day. Okay. So that's a holiday. What happens if your 180th day lands on a holiday when the county recorder is closed, escrow is closed, the title company is closed, we're closed? You don't get to the next business day. It's that day or before. Well, what happens if it's the weekend, that it's a Saturday or a Sunday when the county recorder is closed? Well, you don't get to the next business day. You close by that day or before. There are no extensions in this 1031 exchange unless there's a major disaster, and the IRS will notify us as to what that disaster is, how much will they allow in terms of an extension. But if that's not the case, you just can't request a extension. There are none. End of story. So you have 180 days to close your that's hard, but that's the way it is. So it's almost 6 months. Not bad. But the next part is the most difficult. I get more questions about this than any other questions regarding the exchange. How many days do I have to name or identify the replacement property? The government limits only the first 45 days of that 180 days. In other words, when escrow closes, you've got the first 45 days after closing to name the address that you're going to buy. It has to be in writing and signed by the client. How many properties could they have on that list? Well, up to 3 properties. They can have any 3 properties, any 3 addresses. They can put in parcel numbers, they can put in legal descriptions if that's what's necessary, but an address will do. They can put down 3 addresses. Oh, can they change properties? Sure they can. They can take property off and put new property on 100 times if that's what they want to do. But please get this next part. Not after 45 days. It's the 45-day identification period. Whatever's on that list, a minute before midnight, that 45th day, those are the only properties that your client may exchange into. You cannot exchange into foreign property. It has to be domestic to domestic. You cannot sell foreign property and exchange into the US. It has to be domestic real estate into domestic real estate anywhere in the country. Can I sell property in Mexico and buy, let's say, in the Middle East and do a 1031 exchange? The answer is yes. You can go from foreign to foreign. You can go from domestic to domestic, but you cannot mix the two together in an exchange. So you only have the first 45 days to identify domestic real estate anywhere in the country and acquire at least one or multiple of those within the remaining balance of the 180 days. This is so important. And this is, if you're going to get tripped up, this is where it is. Let's go back to that zip form we just discussed. Now, doesn't it make sense where under the seller's intent to exchange, the SXA form, remember I said you could negotiate an extension to your sale if you haven't found your replacement property? Well, this is why. Because you have 45 days as drop dead to submit your identification or your exchange is over. So folks, can you get out of the exchange at that point? The answer is yes, if you haven't deleted or revoked everything on your list. You can't change that list, even revoke after day 45, only within the 45 days. This is so important. And if your exchange is going to trip up, this is it. That's why negotiating that extension of a 30-day contingency, and the contingency will be based on your client going into escrow if that's what you want, the client approving a physical inspection report of the new property if that's what you want, and maybe even approving a prelim to make sure there's no cloud on title if that's what you want. You can put anything in that contingency, extend it as long as you want, but you have to negotiate that in writing with the buyer when the buyer submits an offer. Okay. Can I do it backwards? Can I buy first and then sell? What if, I don't know if you can hear that, that's opportunity knocking on my front door. What if a property just drops out of the sky and it's a beautiful property and it's in a great location and I'm going to make a lot of money off of that? And I have the ability to pay cash for it, or I have the ability to have cash but I'll get a lender, whether it's a swing loan or bridge loan, a line of credit, hard money, whatever. Can I close the purchase first so I don't lose it? And then close my sale up to 180 days later? The answer is yes. That's called a reverse exchange. When we come back next time, I'll go into more depth. But just for today, because there's a lot of information involved in this reverse exchange, remember, this allows you to close, not open escrow. It doesn't matter which escrow you open first. It allows you to close the purchase first and then close the sale. It's going to require two things. And we'll get into this more next time. Look at the 2 bullet points at the bottom. We have to set up an EAT, an Exchange Accommodation Title Holding Corporation. The federal government mandates that we hold title to either the one you're selling or the one you're buying. And number 2, you have to have the cash to be able to do it, or cash and financing. So as long as you can perform these 2 items, we'll set up the holding corporation, we'll take title to either the one you're selling or the one you're buying, and then ultimately you close a sale, that sale, within 180 days, and that's a good 1031 reverse exchange. Quickly, let's talk about the monetary requirements. When you're selling, the government says you can deduct off your sales price the following items. This is a good page to take a picture of as well. Commissions, escrow, title insurance, transfer taxes, recording fees, exchange fees, or any kind of contractual agreement that you have with the buyer to pay for whatever they've requested. I'll give you an example of what that looks like. You sold for $1 million. Your cost to sell that, ones that we just went over, the non-recurring, is $70,000. Number 2. Number 3, $1 million minus 70 leaves you a net of $930. If you have no loan on the property, we will take the $930, we will put it into the purchase of the new property. That's what the government requires. So your new purchase price is $930, not $1 million. That's your minimum purchase price. You can go up. If you go down, you pay taxes on any cash that does not go into the purchase. Number 2, if you do have a loan, then that loan will be paid off. That's number 4. So if you pay off a loan, a first, a second, a HELOC, line of credit, cumulative loan balance is $400,000 in this example. 930 minus 400 equals 530. No, your new purchase property will not be 530. It still has to be 930. The sales price minus the non-recurring closing cost. So how do you get back to 930? The answer is you reborrow the $400,000. What does that look like? You get a new mortgage, or you bring in new cash from your savings account and put in an extra $400,000 into the acquisition to make up the mortgage replacement difference. The seller can carry back for you when you're buying the replacement property. You could assume the seller's loan. I just had somebody do that because it was a 3.8% loan, and they wanted to assume it to get that kind of interest rate. They were able to do so. That is allowable. Or you can take the property subject to existing debt, or any combination of what you see here in bullet points. That is debt replacement. So you have to replace the 530, you have to reborrow or bring in your cash at 400, that gets you back to 930. That's your minimum purchase price. If you borrow less, you pay taxes on the difference. Remember, you get to put new cash in. And any cash that doesn't go into the acquisition, you pay taxes on. We'll put in the EMD if we're holding the funds at that point into the purchase of the new property. The client can allow us to do that. The money is going to be safe because it's not going to be commingled. It's going to be in a client trust account. It's not going to go into a corporate account of ours. It's going to be in that client trust account at the bank. The client has to sign a written authorization for the money to leave the account. There are no verbals. And we will go call them back to verify that they sent this to us to make sure it wasn't a hacker or somebody trying to steal their money. There'll be bonding and errors and omissions insurance, internal legal department. This is what you need, whether you use our company or somebody else's. You got to make sure that these things are executed, because if they are not, your exchange might be going down. because we've seen people, accommodators go bankrupt or steal money. And you got to protect your client. All right. There's lots of things I'd love to talk about now, but we're getting run out of time, and I want to take, all these questions that you have and answer them. But let me just answer this one real quick. The question is, when I sell the property, do I have to take it in the same title that I sold it? The answer is maybe. Most likely, yes. But I want you to look at the bottom in green, and we can talk more about this next time. You're not a name. Not to the government, you're not. You're a number. And your number is the tax ID number of the property you sold. So whether it's in your social security number, or if it's got an EIN or a TIN number, how you exchange it is the same tax number. Has to buy. So if that vesting is the same, that's perfect. If the vesting is different, but it's the same tax ID number, like when you sell in a trust, and sometimes the lender won't let you buy in a trust, as an example. As long as that tax ID number is the same, it's good. Okay, let's go to this page, and this is where we're going to wrap up our time together, and then we're going to answer questions. I've got seven, so this is just seven important questions on questions that your clients are asking who own rental properties. And all the different kind that we just talked about, whether it's single family or condos, 2 to 4 units, 5 units and above, commercial, industrial, whatever, storage unit, gas stations, car washes, office space, it doesn't matter. What matters is they've been using it as an owner user, or it's vacant land, or it's being rented out. These questions will stimulate things like, how do I get more cash flow or income from my property? How do I measure its performance? How do I get more appreciation? How is my tax write-off still working out for me? How do I reduce stress and time? Can I go, as I get older, into other properties that I don't have to be a property manager anymore, like a triple net property, where Starbucks is my tenant, or Trader Joe's is now my tenant, or Chick-fil-A is my tenant. Folks, there are so many opportunities to go into different properties that will help your client sell and buy and do a 1031 exchange. If you're interested in these, you can send me an email to philatwan@gmail.com, and I will get you those letters. Just give me a couple of days, because I think I'm going to get a lot of requests. And the bottom line is, you can begin to develop a relationship with people who own these kinds of properties through your title company, and now have something to send to them that can certainly appeal to the reasons why they bought the property, and why releveraging might just be a good thing for them in 2023. By planting the seed today, these 47 days or whatever it is that's left in 2022, gives you a head start for your 2023 in January. Well, Duncan, my part is finished, even though I can keep talking for another hour and a half, and I'm not exaggerating. But let's talk about those questions that are in the chat box.
Sure.
And, what do you have in there that we could answer today?
Okay. Can you hear me, or am I still?
I can hear you perfectly.
Okay, great. So the first question, I don't know if these people are still on. By the way, give it up for Phil. I don't know how you applaud on Zoom, but he does a great job. He crushes it every time. And again, if you want those letters, certainly email him. And you guys know that you do need a facilitator to do a 1031 exchange. So Phil's a great resource for you, just about general knowledge, as well as being able to handle that. So thanks, Phil. And again, I'm Duncan with Chartwell Escrow. I'm here to help you guys as well. If you like this presentation, we're going to do monthly rollouts of some kind of value add for realtors and lenders. So if you have any ideas, or you want to see something, please let us know, because we're open to suggestions and ideas. But we would love to continue to work with you guys, provide value. And again, as an escrow rep, my role is really to partner with you guys, be a partner for life, and see how I can add value to your business. So with that being said, let's get to the questions. let's see, if your property is not located in California, do you still have to pay California tax?
The answer is yes, if you live in California. So if you live in California, your property's in Texas for whatever reason, and you want to exchange the property, you will have to pay taxes over what Texas will charge. Well, in Texas, I think it's a tax-free state. But so you would pay 100% of the California taxes because you live here. If it's the other way around, you live someplace else and you sell property you own in California, yes, you will have to pay California. That's why escrow has the 3 1/3% withholding to make sure that they at least get a big chunk of it. And then when you file the tax return in California, then you either pay the balance of what you owe or you'll get a refund for the overpayment that you made. Good question.
The next one is, does this include a primary residence, the California state SND, the Medicare off primary residence as well?
Yes, it
Okay.
does. Remember, any kind of real estate, as long as your gain is 200,000 or more as an individual, or 250 or greater as a married couple, you are eligible for the healthcare tax, the Affordable Health Care Act.
Okay, and then someone else had inputted all the numbers you had in that one slide, 15 to 20% plus 3.8 plus 9.3 plus 25. Is that the total taxes owed paid on investment?
No, and the 25% is only for the amount of depreciation that was allowable to take. So for example, if you had $800,000 worth of depreciation that you could have taken, whether you took it or not, you would pay 25% tax on the 800,000, which would be what, 200,000, in addition to the capital gain of the 15 to 20%, the 3.8, and the California state tax. At that point, it'd probably be close to 13. So yes, that's what you would pay. So you don't combine the 25 with the other one. It's the other three plus the 25 on whatever the allowable depreciation has been.
Awesome. Danny is asking that they heard that a houseboat also qualifies. Is that true?
No, it has to be real property.
Okay.
Sorry.
And what
Once
about
upon a time, personal property was allowable if you used a personal, like a plane or a boat. But unfortunately, that all changed several years ago. And it's only real property now, no personal property.
Okay. What about an Airbnb that you sometimes use?
No problem, qualifies.
Okay. Kevin is asking, can you please go through an example of a stepped up basis?
Yeah, I bought the property for $300,000. It's gone up in value, whether I've exchanged or not. Assuming that I did, then I've re-leveraged and it's grown more and more, right? So now I decide to sell the property. If I sell it for $500,000 and I bought it for $300,000, I have roughly a $4.7 million gain. I'll have to pay taxes on that. But when I die, assuming that I have it set up with an attorney with the right kind of vesting, and that trust is just one way of doing it, it's what I like the best, but there are other ways of doing it. Your heirs will receive it at the 5 million or whatever the value is at the date of your passing, which means they don't have to pay the capital gains, or if they hang on to it, their new basis is set up at the fair market value, not what I paid for it, but what they received it at based on what it was worth, the day I passed.
All right. And Pamela asks, can we name the address of a condo building, but not the unit number if they're not sure yet?
No, it has to be a non-ambiguous description. So if there's a letter or a unit number, you have to identify it. And even if it's a new housing tract and you want to buy a single family rental in it, you have to identify its specific address or its tax parcel number or its legal description. Sorry.
Mark asks, is there a specific best way to handle an inherited property in the state of California?
Well, I don't know what he means by that, but the bottom line is, remember, If you inherit a property and the basis is a little lower than what you thought, or the gain just went up from the time you've held it, you may have held it for 10 years as an investment and rented it out. As long as you've rented it out for the last couple of years, then you could do a 1031 exchange and take that stepped up basis to whatever it was stepped up with to the next property, or diversifying to multiple properties anywhere in the country.
Cool. Ross asks, who pays the facilitator and how much does it cost?
It's the client who pays us. If it's a delayed exchange, it's $1,250. That includes one sale for the documents to work with you folks at Chartwell, one purchase. If there's any additional sales or purchases that are more than just the two, then it's $350 for each additional property. But it's just $1,250, and that includes the two properties. If it's a reverse exchange, it starts at $8,000. We have to set up the holding corporation. The paperwork increases by tenfold. We have the attorneys in-house we have to pay. So all that costs more, and that's why it starts at $8,000.
Okay, and I believe the last question we have, Kale asks, capital gain tax, 15 to 20%. Is it based on the profit? Is it based on the profit, or is it based on the sales price? For example, I bought a home 5 years ago for 500K. Now I sold it for 800K. Is the capital gain tax I pay based on the 300K or 800K?
It's based on the gain only, not the sales price. Remember that. In fact, since this is the last question, I'm just going to run this backwards for a little while. We'll go back to that sheet so you can take a look at it. It is getting close, getting close, getting close. There it is. Oops. There it is. The sales price, number one, minus what you purchased it for, number two. But what you purchased it for is called your adjusted basis. That means you would add any capital improvements that you put into the building that would raise your basis. Depreciation lowers your basis. Closing costs raises your basis. So that basis will adjust, and the CPA will have to do that. So at the end of the day, after you close escrow, the sales price minus whatever the basis is adjusted to equals the capital gain. And you pay taxes on the gain. Again, if this is your principal residence and you qualify for the 121 and you're married, you get up to $500,000 off that $700,000. If you're single, you get up to $250,000 off that $700,000, which means you'll now pay taxes on $450,000. If it's a second home or a vacation home, you get nothing off of it. Your gain in this example is $700,000. If it's a rental property, you decide opt to not exchange, your gain is going to be taxed at the 700 plus the recapture tax. And those are the taxes that we just mentioned, right? Oops. Going more on. There we go. Based on this particular slide. That makes sense?
Awesome. Thanks everyone for showing up. If you want to follow me on socials, I'm escrow_king on Instagram. Would love to connect with you all. And again, Phil gave you his information. Feel free to call him for those letters to send out.
Well, don't call me for the letters. Just email me, because there's
email him.
Yeah, just
email
request
him.
the marketing letters, or if you have a question on a 1031 exchange, it doesn't. If I'm not the accommodator, I'll still help you. It's my pleasure, because like you, I believe in relationships. So the bottom line is, call me at my 213 number in red below, or just for a question, or if you want the letters, I'm happy to provide those to you via philatwan@gmail.com. Duncan, thank you. This would not have happened if it wasn't for you today. So my best wishes for you at Chartwell and all the growth and that you're going to help your agents in terms of your relationship with them. Thanks for inviting me today. Maybe we'll do a part 2 in the not so distant future.
Take care, everybody. Have a great week and a great holiday.
Thank you, everyone. Happy Thanksgiving. Bye-bye.